You spot a technically perfect breakout on the Euro USD. You enter the trade, set your stop loss, and watch as the price completely flatlines for 6 excruciating hours. You didn't get the direction wrong, but as you wait in that stagnant market, your broker's spread slowly widens, bleeding your account pip by pip until your stop loss is triggered. This happens because many traders treat Forex like a 24-hour buffet, assuming market conditions are equally ripe for trading at any hour of the day or night. The problem stems from confusing liquidity with volatility. Liquidity is the market's depth, the ability to place a trade without moving the price. Volatility is the actual, measurable movement of that price. A market can hold massive liquidity while possessing zero volatility. If you apply aggressive breakout strategies during these quiet hours, your setups will likely die in the water. Every trade interacts with the collective, location-based psychology of institutional banking desks in hubs like Tokyo, London, and New York. Protecting your capital requires looking past the 24-hour clock and learning to identify the specific behavior shifts that occur as the sun moves across the globe. The daily cycle begins with the Asian session, running from midnight to 09 GMT, driven primarily by Tokyo. During these hours, aggressive speculation is rare. The volume you see is dominated by commercial hedging and central bank currency management. This creates a sideways market grind. Even though this session holds roughly 20% of global volume, the price amplitude remains constricted because the institutional activity isn't designed to drive a trend. To survive this environment, you have to abandon fast-moving breakout strategies. Instead, you can look for patient mean reversion trades or isolate your focus to regional pairs like the yen and yuan proxies. Recognizing the Asian session as a consolidator prevents you from forcing aggressive trends into a market designed to absorb them. At 8 a.m. GMT, the global timeline shifts westward. As the European banking sector comes online, market behavior transforms entirely. The London session acts as the primary trend setter. It initiates approximately 70% of the day's sustainable directional moves. But that heavy volume attracts predators. The first 60 to 90 minutes of the London Open is known as the institutional kill zone. Look at this line chart. This false spike, the Judas Swing, is designed to trigger early retail stop losses before the real move. Institutions require your trapped liquidity to act as the counterparty for their massive true direction orders. Understanding the mechanics of the kill zone allows you to survive the initial trap and ride the true institutional wave that follows. At 1300 GMT, the United States wakes up, introducing heavy economic data and the influence of the US dollar to the market. This window is known as the golden window, occurring from 8 a.m. to 12 p.m. Eastern Standard Time. During these 4 hours, the massive liquidity pools of London and New York operate simultaneously, resulting in the day's tightest broker spreads and the highest statistical probability of a 50 to 100 pip move. But the clock is a moving target. Because the US and Europe change their clocks on different dates, the daylight savings time trap can shift this golden window by a full hour, causing you to miss the peak liquidity. Even more dangerous is the dead zone, striking around 5 p.m. Eastern. This is the gap when New York closes and before Asia fully opens. Liquidity evaporates here, causing spreads to balloon. Notice in this diagram how the bid and ask lines widen and slice through a stop loss, even though the actual market price hasn't moved a single pip. Mastering the market means exploiting the golden window for tight, fast moves, while abandoning the board during the artificial spread dangers of the dead zone. The market is not obligated to provide trading opportunities simply because your platform is turned on. You must apply pair session synergy, trading specific currency pairs only when their underlying geographic banks are online, like trading the EUR/USD specifically during the overlap. Audit your last 20 trades. You may discover that your unexplained losses disproportionately fall into the Asian consolidation grind or the dead zone. Stop acting as a reactive clock watcher. Map your trade entries against real-time session overlaps where the volume is highest. Download our Forex session cheat sheet and use the FXNX market clock on the NX1 platform to ensure you only trade when the institutional odds are mathematically in your favor.